Welcome to our weekly market review, and for the South African market, the focus this week will fall on the first MPC meeting of the year. Not surprising, the SARB is expected to hold, so the focus will fall on the bank's accompanying forward guidance. Most investors seem to expect the first rate cuts only in the second half of the year, but there are several factors that play into this: the performance of the US dollar, the price of oil, and the Iran's ability to stage somewhat of a recovery. But given the global conflict situations as well as the geopolitical tensions, these factors are tricky to predict. Preceding the SARB is the release of the latest CPI and PPI data. Both are expected to have slowed, perhaps even at a quicker rate than anticipated. And if that's the case, it could nudge the SARB to move quicker on rate cuts. But Kganyago and his team will likely want to be confident that inflation is secure at that 4.5% midway point before they will make a move. Then ratings agency Fitch came out this weekend announcing that it will keep South Africa's rating unchanged, but warns the country faces a bleak growth trajectory with the failures at Transnet particularly concerning. This announcement, along with the upcoming SARB event, is likely to keep investors cautious in their position taking this week, and in the absence of any other support, this has been constraining the rand's performance. South Africa is not the only one with rate decisions this week. The European Central Bank is expected to keep rates unchanged, and there too the focus will shift to the forward guidance, with the bank likely to keep rates on hold for most parts of the first half of the year. And then there's Japan, and although the central bank is expected to keep rates unchanged on Tuesday, it will likely start laying the foundation for policy normalization, and this has the potential to rock the global financial system. You see, to reverse Japan's disinflationary trend, the central bank kept an ultra-loose monetary policy, and this sent Japanese investors abroad looking for better returns, and they spent trillions in markets abroad. Now, with inflation gaining traction, we are expecting the central bank to start normalizing its monetary policy, and this could prompt Japanese investors to disinvest and reinvest in their local economy, causing a bit of a rumble in global markets. Also coming up this week is the Q4 GDP figures in the US. Growth is expected to have moderated. I briefly spoke about the situation playing out between the Fed and the markets last week, with the markets seemingly expecting a much harder economic landing than the one currently being sold by the Fed. And for this reason, their rate cut expectations are vastly different. We will be publishing a podcast on rate cut expectations for 2024. You can check out Markets Magnified on YouTube and Spotify. Global PMIs will also be released this week, which will provide some indication of the state of the global economy while providing some nuance to the warnings of a broad-based global downturn. That's it for the week to come for the markets.